Hello, and welcome to the Wealth Consulting Group's mid-year market update. I'm Jim Worden. I'll be walking you through some of the things that we see in the markets and in the economy. So investors have been wondering about these three questions. Really, will inflation come down? Will we have a recession? And more recently, are we in a bubble? Now, we did have another question that was related to, will our government reach a deal on the debt ceiling and will we default? So fortunately, we've gotten through that. We've climbed that part of the wall of worry. And now we've got these three questions. The first two questions have been here for a while. The third question is a little bit newer. We're going to get to each of these. So on the question of inflation, will inflation come down? Well, the answer is inflation is coming down, but we have to look at a little bit of a historical context in terms of how we got here. When we look at inflation going all the way back to the early 70s, we can see there's a lagged correlation between the M2 money supply growth and inflation. And so we can see that during periods where we had high inflation in the past, those often preceded periods where we had massive growth in M2 money supply. That was no different this time around when the government issued a lot of bonds, and we also had reserve requirements that came down to zero. We had a lot of government checks going out to individuals during the pandemic, PPP loans. There was a lot of growth. This is unprecedented growth in the money supply. Now, the money supply has since come down and actually turned negative for the first time since the early 70s. We're seeing inflation come down, which is the blue line. The money supply is the orange line. We're seeing inflation come down, but it's a lagging the money supply. We will likely continue to see money supply come down and inflation come down. But let's give you a little bit more context on the money supply. So this is just looking at the growth in money supply over time. And you can see that we've followed a pretty good trend line of money supply growth. Leading up to the global financial crisis, that trend line shifted upward and we started growing the money supply more. That was mostly due to the Federal Reserve and trying to ease the situation around the global financial crisis. There was a lot of quantitative easing that happened, some increases in the money supply. That has been continuing on a higher trend line until the pandemic. And during the pandemic, you can see this blue line shoot almost straight up. This was all of that money coming out. Now you can see that it's come down. It has declined, still very, very far from the trend line here. We do believe that there's still some money out there that has not been used. There's some excess money, there's some excess liquidity out there in the markets. And as that is used, we will likely see some slower growth. Some people are calling for a recession. We are seeing slower growth. Now, when we look at where the Fed has been in combating this, they have kept rates at zero for a very long period of time. Most of 2020 after the pandemic happened, all of 2021, and for the early part of 2022, they kept the Fed funds effective rate essentially at zero. This is just a little over zero, the mid price. But you can see the orange line is the Fed's own measure of inflation, which is the personal consumption expenditures index. And this is core inflation. So we're not looking at energy or food. But we can see the orange line here started spiking in really mid 2021. And if you remember, what did we hear? We heard a lot of talk about this is all transitory, this is going to go away, it's temporary. And it just kept going higher and higher and higher until the Fed decided that they have to take some drastic action. And they've started raising rates very, very abruptly. And now we are at the point where the Fed funds effective rate is now higher than this inflation measure for the Fed. So it stands to reason that, just like yesterday when the Federal Reserve paused, the Fed will be looking to slow this hiking cycle down or pause, and eventually they will cut rates as inflation comes down. Now, economists that have been surveyed by the Wall Street Journal every few months, back in January, they thought inflation would be coming down quicker. Last April, the survey indicated that it's taking a little bit longer, and that makes sense. There's still this excess money. There's still a lot of consumers that are spending. Consumers are still very healthy. There's a lot of money that's being spent in services. If you travel and you're in an airport, a lot of the airports have been very crowded. The planes have been full. And so this is on the backs of healthy consumers. And so this just means that inflation is going to take a little bit longer for it to come down than what economists were originally expecting. And we can see here what economists are thinking in terms of the Federal Reserve, in terms of when the next rate cut will be. So you can see that information here. The Fed funds futures are trying to price in when the last rate hike will be and when we'll start having cuts. So as early as last month, we can see that the probability for hikes were much lower even just last month. And the futures were pricing in that by January of next year, we would have an implied rate of 4.2%. Now, looking at this through June 8th, those same futures are pricing in that we would have a rate of 4.8%. So that's about 0.6% higher. And that's mostly related to this inflation coming down slower. So now we have another question here about, will we have a recession? And really going back to this Wall Street Journal economics survey, we can see where people, more than 60 economists are kind of polling here that this is a 61% probability. That's the consensus. Now you can see in the far left here, when we had a recession in 2008, 2009, this was the global financial crisis. At the beginning of the recession, people were only polling that we had around maybe a 30%, 35% chance of a recession while we were already in a recession. So it's important to keep in mind that we did not actually really think we were going to be we were really going to have a recession until we were already in it. And that's because the National Bureau of Economic Research usually comes out and says we're in a recession, and by the way, it started 6 months ago, or it started 9 months ago. And so by the time the news media picks up on this and says we're in a recession and the alarm bells are going off, this is not a good time for investors to be alarmed or be concerned or think about making changes in the portfolio. And that's primarily because this is we've already been in a recession for a number of months, and the markets likely have already bottomed before that happens. And so it's just really important, critical to remember that often we're in a recession before we even know it and before it's announced. So we can see right now that, again, that the probability per the Wall Street Journal survey is 61%. It's also important to keep in mind that of all those economists surveyed, it's a very incredibly wide range of forecasts. We have forecasts that cover the whole amount. We have one person saying that there's a 1% chance of a recession. And we have a few people that are saying it's a 100% chance of a recession. So someone in that 1 to 100% range is going to be right. It's going to be somewhere in between there. The average forecast, again, is 61%. When we look at the median forecast, that's 65%. That's right in the middle of the forecast. The most common response by these economists is roughly 70%. Now, our forecast is in the 30 to 40%. But there are a number of other economists that are also believe it's in the 30 to 40% range, such as Goldman Sachs. Now we have to look at the weight of the evidence to see, do we really look like we're going to have a recession right now? And that's how we have to look at this. We can't forecast this 6 months ahead because we don't know. Things could change. Things could look much better than they do now. They could look worse than they do now. So we have to look at the data now to see what's happening. Now, the first piece of data here that we look at, and this looks very bearish that we may have a recession, is the yield curve. And so there's a number of different measures of the yield curve, but the one that we like to look at is the difference between the 3-month T-bill and the 10-year Treasury. Now, typically, when we have a normal yield curve where in the beginning, the very front part of the yield curve, we're looking at 1 month, 3 months, 6 months. These are going to be paying a lower interest rate than 1 year, 2 year, 5 years, 10 years. But right now we're in kind of this inverted yield curve where everything in the front part of the curve is paying considerably more than things at the very back of the curve, the 10-year, the 20-year, and the 30-year. And so this graph just shows that right now you can make about 1.5% more on a 3-month T-bill than you can a 10-year Treasury. Now you can see here the red lines here, the red pink lines here, that indicates that we've had a recession. Now you can see before each recession, we've had this yield curve invert. That means it went below this red horizontal line. Now, if we go back way, way far and we look at different curves and we look at the 1 year and the 2 year, this is not always 100% accurate. There have been a few times where the yield curve inverted and we did not have a recession. Looking at the mid-90s, we actually did have an inversion here, and we didn't have a recession until much later when we got to 2001. So sometimes this takes longer for the recession to happen. Again, it's not meant to be a timing tool with investments and what's happening in the economy, because this does have a very strong lead on when the recession happens, right? So that's the first piece of evidence. This looks like we certainly could have a recession. Now let's look at another slide here. The unemployment rate going back to end of World War II, we can see that every single time we've had a recession, we've had a spike in the unemployment rate. And you can see that's the blue line here. Every single time we've had different levels, and it hasn't gone up the same amount each time, but every single time we've had a recession, we've had a spike in unemployment. The pandemic recession that we had, which is this very, very skinny pink line, is no different. We had unemployment spike from roughly 3.5%, all the way up to more than 14%. This is around almost 15%. And it came right back down because we had some things put in place, and we opened the economy back up. And now where are we? Well, we have been hovering in this 3.4 to 3.7% unemployment. Very, very low unemployment. Now, I don't know about you, but I would not consider a move from 3.4 to 3.7 a spike in unemployment. This is still very, very low. If we see this move up to 5 or 6 in a very short period of time, that could mean that there's a recession going on. But for now, we have not seen this move up. So what else can we look at? As it relates to employment, we can look at job creations. Now, every month we have this non-farm payroll number that comes out. And for the last several months, we've been creating more and more jobs. The household survey that looks at the number of people that have a job rather than the number of jobs, this has been increasing too. So this still looks good. We have never had a recession with unemployment very, very low and all of these jobs that are out there, and there's more jobs available than there are people for the jobs. All right. So the next thing we're going to look at is initial jobless claims. So these are claims for unemployment. Typically, when we start getting concerned here is when we start seeing more than 400,000, 500,000 claims for unemployment benefits. We're not seeing that. We have a little bit of an increase here recently, but this is still very low. This is something that has stayed low really since the end of December 2021. It came down. It's still low. It's moved up a little bit, but this is still in a pretty good spot. Now, so let's look at the next area that might give us an indication of how the economy is doing, and that is looking at high yield spreads. So this is really just the difference between a high quality government bond that's backed by the full faith and credit of the U.S. government and an equivalent bond that's low quality. Right. And this could be an average, looking at the average low quality bond. And so the prior recessions that we've had this spread increase well above 5% during the recession. In 2008, we saw this move up almost to 20%. This was a very, very distressing type of situation. Even during our COVID pandemic, we had this move from 4% all the way above 10%. And where are we now? Well, we're below 5%. We've kind of been bumping around, but we're right around 4.2%. This is still very good. This is notwithstanding all of the challenges that we've seen in the banking sector. So this is a good piece of evidence that currently things still look good. Now, how about profit margins? Profit margins typically will shrink during recessionary periods, and we can see these last few recessions that they did come down significantly. Now, what's a little bit unique about our current situation is, yes, profit margins have shrunk, but where we're at is almost at the same level as prior to the pandemic, which is near multi-year highs for profit margins. So that's a good sign. Now, if this continues to come down, that would be something that we would be concerned with. What about profit growth? So here we're looking at the earnings of the S&P 500, both the trailing 12 months, as well as what analysts are forecasting for the next 12 months. And we can see that the orange line, which is what the analysts are looking for, hasn't really come down that much. The blue line, which is what's already happened, hasn't really moved down either. And so some of the people in the media have been saying for a long time, probably more than 6 months, they've been saying earnings are going to crash, profits are going to crash, we're going to have this terrible recession, profits are going to drop by 20%. We just haven't seen it. We have to look at the data. We did see profits come down significantly during the COVID pandemic. They came down a lot during the global financial crisis. Every other recession, earnings came down some, except for the late 70s. We actually saw that profits actually increase. So this is not a perfect indicator, but it's along with a string of other indicators that look at recessions. And so because of this, we believe that we're not going to have a recession. The chances are still significant. A 30 to 40% chance is still significant, but we believe that we have a very strong consumer, and that means two things. That means inflation is going to come down a little bit slower. It also means that growth is not going to come down as fast. Now, it may mean that the markets have to kind of, adjust and calibrate to what is the fair value. But the next question here that people have been asking more recently is, are we in a bubble? Now, I have to tell you, I don't think we've ever been in a position where we've been talking about a recession for 12 months, 6 to 12 months, or are we in a recession? We're going to be in a recession. And now we're talking about being in a bubble at the same time. This usually doesn't happen. Now, sometimes we'll be in the bubble and the bubble will get burst after the Federal Reserve raise rates and keeps rates high for an extended period of time. And then that puts us into a recession. But never have we been anticipating a recession for this long. And then now all of a sudden there's some concern about a bubble. So we'll talk about this too. So if you remember, last year was a really, really hard year for the equity markets. If you recall, only energy performed very, very well. And if you owned energy, and if you owned a little bit more energy in your portfolio, as we did in our portfolios, you did well because energy was up more than 60% for 2022, while most of the rest of the market was down significantly. Now that has flipped. So the sectors that got hurt the most in 2022, information technology, communication services, and consumer discretionary, these three sectors are leading the way. And we can see big performance here. Information technology up 35%, communication services up 32%, and consumer discretionary up 26%, all while the market is up maybe 12%. But you have some sectors that are actually down. For example, utilities and financial services are down year to date. So some people may be looking at this and say, well, this is definitely a bubble. I should be worried and maybe I should get my money out. We don't think so. Okay. Another thing that people will look at is, well, what is the difference between the NASDAQ and the Russell 2000? And they'll look at this and they'll say, well, relative to the Russell 2000, the NASDAQ is performing so well. And, people will say this also happened before the bear market of 2021 and 2022 when things came down. Actually, more it was 2022. But people would point at this and say this could be a bubble. Now, if we look at the top companies of the S&P 500, so the top 7 companies, and years ago, there was an acronym called FANG, and everyone used to wanted to own the FANG because the FANG stocks, Facebook, Amazon, Netflix, and Google performed much better than everything else. Now it's the top 7, the very largest 7 companies of the S&P 500. And this is MagMat. I apologize, the acronym's not too catchy, but this is really Microsoft, Apple, Google, which is Alphabet, Meta Platforms, NVIDIA, actually Amazon, NVIDIA, and then Tesla. So you look at those, all of those have on their own performed tremendously. All of them are up more than 30%, but you see Meta's up 120%, NVIDIA's up 166%, Tesla's up more than 100%. When you combine these together, just those 7 names, you're up 51% for the year. Now, how's the market doing? When we look at the other 493 companies and we add those to the 7, then the market is up roughly 12%. Now, if we take all 500 companies and we say, let's equal weight them, let's give the same weight to all of them, now we're only up 2.5%. And so some people would look at this and say, well, this is a bubble. These big companies, are going to come down. They're very, very rich. Well, let's also kind of look at each of these companies too. These are companies that have been around for a while. They're not brand new. They're generating a whole lot of free cash flow, and the cash flow return on invested capital is high in every single case. And then you've got growth coming out of these companies. And where is that growth going? That growth is going to cloud computing. It's going to accelerated computing. It's going to more demand for cloud services. It's going to artificial intelligence. And we'll talk about that here in a minute, but these companies are not like the dot-com companies that weren't making any money. They just had a business plan that was on the internet, and many of those companies failed because they weren't doing anything. They weren't producing any revenue or profits. All of these companies are producing profits and high amounts of revenue. And so the interest in AI really is been the theme of this year as it relates to technology companies and consumer discretionary, as well as communication services. We can look at other companies when they launched. How long did it take for them to get to their first 1 million users? Well, Netflix, it took them 3.5 years to do it. Twitter took 2 years. Facebook took 10 months. And ChatGPT took 5 days. So then we look at, okay, well, what about the first 100 million users? Well, the time to get to 100 million users, for Uber, that took 70 months. For Spotify, that was 55 months. We look at Pinterest was 41 months, Instagram 30 months, and then TikTok was 9 months, which is still incredibly fast, but ChatGPT was just 2 months to get to 100 million users. And so there's been a tremendous amount of interest in AI, and this is not just by consumers, by the way. When we look at companies, large companies and small companies, all the companies that are reporting their earnings and they're talking about revenue and costs, we can actually look through Bloomberg and we can see how many times did they mention AI and what was that in reference to. So this kind of pairs off AI and all of these other topics, all of these other subjects. So as it relates to cloud computing, just a few quarters ago, back in 2019, we had this mentioned 304 times, right? And now this most recent quarter, it was mentioned 830 times in conference calls. As it relates to revenue, we went from 192 mentions to 794 mentions. So this is these are companies talking about how AI is generating more revenue for them. Now, it's not just revenue, because we can look at labor costs. Labor costs, the relationship with AI going back to the fourth quarter of 2019 was 11 times mentioned. And now we're looking at 81 times mentioned. So for companies to be able to increase their revenue, both increase their revenue and cut their labor costs, that can be tremendous for profit growth and profit margins. We can also see things like ethics and compliance in here, which got 8 times mentioned back in 2019, and now it's mentioned 61 times. Clinical trials, and so healthcare companies that are using AI to do their research more effectively and to analyze the data more effectively. 14 times it was mentioned in 2019, and now it's mentioned 54 times. So massive increases, all aggregated together, 8 times the amount of mentions versus 3 years ago, and versus just a year ago, 3 times the amount. So there's a lot of exciting things happening here. Now, at the same time, I just have to put out the caveat that there are also companies that will be speculative, that won't be like these large companies that are generating a lot of profits, generating a lot of revenue. And some of these companies will be speculative. And we would say to be very, very careful with any of the companies that you're investing with. But this is just an interesting thing to show you that, it's not just consumers, but businesses are very, very much interested in AI. Part of this interest, by the way, is cost cutting. So there are a lot of companies that have got lots of capital spending tied up in cloud services and cloud computing. There's estimated $1 trillion, according to NVIDIA, that is tied up in cloud computing, mostly related to CPUs. And these are the central processing units, the regular chips that are found in computers. There will likely be a transition. There may be a transition to much more GPUs because these are accelerating the performance of the cloud and the cloud services and the network. And that's going to save money. And it's also going to perform better for some of these more intense queries and the load that is on the cloud computer. So that is what I have to say about AI as it relates to general markets. The good news here is that we are seeing more breadth of the markets. In other words, we like to see not just 7 companies participating, but we like to see hundreds of companies participating. And so for the S&P 500, we did go through a period where we were only getting maybe 40% of the companies above their 200-day moving average. That number is closer to 60% now, as of June 8th. The Russell 2000, so the 2,000 smaller companies that we look at, for a number of months, this was kind of averaging like 30 to 40%. This is now picked up to roughly 50%. So that's very good news. The NASDAQ 100, these are the top 100 of the NASDAQ. So it's not just 7 companies, but we have even had better participation here in breadth around the 70% level. So we like to see this. We believe that for the market to move higher, we will need to have continued improvement with breadth, and for breadth levels to stay high. Now, when we look at the S&P 500 and the current trends and momentum, we can see that things did bottom out in October of last year and have progressively been getting better. This downturn that we were in, really from December of 2021, seems to have reversed, and we're now in an uptrend. And so you can see here that we've broken out of this resistance around the 4,200 area, and now we're actually over the 4,300 area as of now. As of this writing, we're just below 4,300. You can see that this momentum, the moving average convergence divergence, has increased. This signal level has increased. We can also see that the trend, which really wasn't that strong, it was kind of messy, has started to turn the corner. The average directional trend has started to move higher. We're getting more positive directional movement than negative. So that's a very positive sign too. And so really the final thoughts here on this, the mid-year outlook are, we believe that housing and services inflation, which are a very large part of the inflation that we're looking at, will take longer to come down, but it will come down. We believe that the Fed might make its first rate cut in the November meeting. Right now, they're in this period where they're pausing. They might actually hike 1 or 2 more times, but it's quite possible that toward the end of the year, they begin to cut rates. And that doesn't necessarily mean that we're in a recession because they're cutting rates. It means that inflation is coming down. Now, the recession probability, again, in our view, is 30 to 40%. That's still significant. But again, it's very, very difficult to pinpoint when that actually started, when that actually ended. And so we don't believe that that is a good tool for doing any market timing. We actually do not advocate market timing. Now, the unemployment rate doesn't necessarily need to spike, and earnings don't necessarily need to collapse for things to slow down. Now, we may have a meaningful slowdown where our GDP growth comes down in the 1% or slightly below 1% or 1.5%. That doesn't technically mean a recession, but it might feel a little bit like a recession. Now, if it dips a little bit below that, that technically could be a recession. The other point here is the race for AI dominance, along with mean reversion and price. Remember those 3 sectors that performed the worst in 2022, they came down really, really hard. Some cases, those companies, those top 7 companies, were down more than 60, 70%. And so for those companies to come down that much, many of these companies have already announced a lot of layoffs. They're turning things around. Those stocks have bottomed and have moved higher. Along with that, the race for AI dominance is also fueling some of this growth. Now, these large mega cap stocks are performing well, and it's possible that there's a trickle-down effect of these investments with other companies. And we could see that some of these very large companies are pulling some of the smaller companies up with them. We're certainly seeing that with breadth. Breadth has improved. We would like to see broader market participation. We would like for that to stay high. It doesn't need to go all the way up to 80 to 100%, but we would certainly like to see that above 50, 60% for these indices. And that is the market update. Thank you for joining me. Hope you're all doing well. Have a great day.